Okay, we're going to be going to full proper evaluation of what we need to do in corporate reporting. As a student intending to write papers in corporate reporting, you should have some basic your basic things to be able to prepare your mind while you are about to undertake corporate reporting papers. So I will call it basic responsibility. Basic responsibilities. Now, basic responsibility, or I can say structure of corporate reporting needs. Corporate reporting needs for students. What you have learned from previous studies involve your calculations, your ability to prepare computation, but at this level you are expected to have getting understanding of some general knowledge. Now, your general knowledge can be your understanding of previous accounting standards, your understanding of accounting standards. Then it looks at part of your general knowledge is your synthesis. The synthesis is talking about ability to be able to evaluate something, and it needs what we call your professional judgment. In corporate reporting, you will be exposed to a lot of case study. Do not, in any question you face, do not leave the question without an element of not passing your own professional judgment. Your professional judgment is actually shaped from your understanding and perspective of the position of accounting standard on that particular issues that has been addressed. So this thing you must imbibe as what we call a general knowledge. Then another thing you must be able to bear in mind is what we call discussion. In corporate reporting, you are going to be faced with a discussive questions. Going to be faced with what we call discussive questions, and your discussive questions will emanate from case studies. Basically, they are case studies, challenges being faced by entities in the corporate world. It will now be presented to you in a form of a case study for you to be able to apply your knowledge. So don't forget, you need a general knowledge, and your general knowledge is your knowledge of your accounting standards and your personal ability to be able to evaluate selected case study so that you can bring out inference, you can bring out your position, which represents like your professional judgment that you are passing in that situation. Now, let's now go to the aspect of what we are going to be starting with in corporate reporting. We call it the national and international accounting requirements. We will start with these questions. You must be able to evaluate and apply basic calculation to show how accounting requirements nationally and internationally affect financial reporting. First and foremost, you need to be able to understand what we mean by accounting requirements. Accounting requirements are established standards. Accounting requirements, they are what? Established standards. Established standards set to regulate financial reporting, to regulate financial reporting processes. They are what? Established standard set to regulate financial reporting process of an entity. These accounting requirements, like we learn from our introduction, we have what we call a standard, the IASB set. the standards, we have what we call IASs and IFRS. I'm going to be talking about these two global set of standards because Nigeria as an economy has adopted IFRS, which becomes effective in 1st January 2012 for all quoted companies in Nigeria. We'll also be looking at a structure of the roadmap for the application both for quoted and unquoted companies in our later discussion. Now that is about what an accounting requirement means. Now, what do we mean by financial reporting? A financial reporting is a process of preparing a published report to users of the financial statements. We have different various information need of users. For example, as an employee, you are a user of financial information. As a creditor of a company, you are a user of financial information. Be it you are an investor, you want to commit an investment in a company, you are a user of financial information. So the process of preparing a financial report to meet the different set of needs of those users of financial information is what we call the financial reporting process. Now we are going to be looking at a quick study of why do we need to regulate an accounting requirement in such a case to regulate the financial reporting process. The first thing that is one of the reasons to regulating accounting processes of reporting entity is to be able to bring about uniformity in presentation. To be able to bring about uniformity in presentation. Another thing is to be able to ensure that financial information portray true and fair representation of its state of affairs of an entity. Now, I will just quickly explain the true and fair representation. The conceptual framework describes this as a concept of a faithful representation. We have seen several organizations in the corporate world presenting or manipulating financial information in such a case that it does not represent what the true state of affair of a reporting entity is. It has an implication. It normally affects understanding of users of the financial statement. It means you are misleading, you are misrepresenting information in that financial statement which is not actually address the true situation of what the reporting state of that entity is. Another reason that we might likely talk about is what we call expectation, meeting the expectation. Meeting what? Expectation of users. Meeting expectation of users of financial information. Now, financial statement on its own does not provide a solution. It is when it becomes useful to selected set of users that it becomes a valid information. So one of the reasons for accounting requirement is it needs to make sure that the expectation of users of the financial statement are met. And how do you meet the expectation of users of financial statements? You meet the expectation of users of financial statement by a concept of what we call transparency in figure. Transparency in financial reporting. If your financial reporting is not well transparent enough, it means the figure that you have provided in the financial statement does not actually represent a true and fair position meeting the needs of users for financial statements. So one of the reasons why we have accounting requirement is to be able to bring about transparency in the process of financial reporting in meeting expectation of users of financial statements. Now, what is the effect of that accounting requirements? The effect of an accounting requirement on financial statements. I will quickly look at a perfect example, a worked example, to address this, so that we'll be able to look at what the effect of financial statement of accounting, the need to regulate an accounting, brings about an accounting requirement to regulate financial information. What does the effect on financial reporting? For instance, if, for example, JC, an organization, let's say JC Limited, he bought a school bag, If he bought school bag, let's take for example, he bought 1,000 school bags for, let's say he bought it for 2 naira 50 kobo each. If he buy it for cash, for example, let's say he purchase it for cash, and as at let's say during 30 January, he sold 30 school bag. He sold 30 school bag out of the purchase for 6 naira each. Now look at this. Look at this perfect example. If there are no accounting requirements, for instance, the reporting entity without an accounting standard, for example, let's say reporting entity without an accounting standard, assuming no accounting standard, the practice will be such that, don't forget, we said he bought 1,000 bags. He bought it 2 naira 50 kobo. This is actually give us 2,500 naira. Now he bought this. If he bought this during January, for instance, his practice would have been to recognize this as purchases. So when he's going to prepare a statement of profit or loss, what the guy will be doing is he's going to recognize what we call a revenue. He know that he has actually sold a portion of it in the financial period. He sold 30. If he sold 30 at 6 naira each, so what the guy will recognize as his revenue is going to be 180 naira. Now on the item that he has bought, these 1,000 bags he has bought, he know that he actually spent 2,500 naira to purchase that 1,000 bags, and he has paid for that 1,000 bags for purchase for cash. So what the guy is going to be doing is that he will recognize what we call the total purchase. He will say 2,500 naira based on layman definition, because he actually spent the whole of the 2,500 naira. So this is going to give him a loss position, and this loss position is going to 2,320 is going to be his loss position. So the guy will be recognizing 2,320 320 naira as a loss position in his book. But this kind of requirement is wrong. So because of the need to bring into uniformity a kind of an accounting practice that reporting entity must follow, that is one of the reasons for having what we call a standard accounting requirement. So the right thing to be done, right thing to do would have been to have a revenue like he have a revenue of 180 naira. Now for his cost of purchase that is going to be matched against that revenue, we call it cost of sales. What it cost him to be able to sell that particular quantity, which is 30 units in the financial period. We have what we call opening inventory, assuming he was able to bring forth a particular element of stock from previous accounting period. Then he needs to add that stock with what he's going to buy in the current period. So from the evaluation, he bought 2,500 watts of school bag in the current period, which is going to give us a position of 2,500 plus the opening inventory. Then at the end of the day, don't forget that he bought 1,000 units of school bag. He's still going to be left with a particular unsold unit that we call closing stock. So you need to be able to value this closing stock. 1,000 units, he has sold 20 out of it. And the valuation of this 20 will be at the cost of purchase at 2.5 naira, which is going to give us 2,425. Now, if you deduct 2,425 from 25, it's going to represent your cost of sales, which is going to be matched with a revenue of 180 naira, giving us a profit position of 105. This is what we call profit. Don't forget, from our previous layman definition without an accounting requirement, is giving us a loss position of 2,320, but from what we have here is giving us a profit position of 105. So that is one of the reasons why we need to have a set of accounting requirements to be able to bring into uniformity, to be able to apply a proper concept that we call matching, or what we call accrual, so that our financial report will be well represented based on the true situation, and we will not be missing out or will not be misleading users of that financial statement. So that is all about looking at the effect of our accounting requirement on financial reporting. It actually makes sure that our financial figure presents a true and fair state of Nigeria. Has a case study. For example, prior to the recent time, the National Accounting Standard, the Nigerian Accounting Standard Board, NASB, is the one responsible for issuing statement of accounting standards. So he has been issuing those standards as an accounting requirement that regulates financial reporting in Nigeria. However, of recent time, 1st January 2012, all publicly quoted entity in Nigeria